Everyone, my name is Emily. Today we will look at what influences the price movements of major currency pairs. Currency pairs are influenced by geopolitical events, central banks' interest rate decisions, and macroeconomic data. For example, the Federal Reserve, the central bank of the US, maintains financial stability by increasing or decreasing the discount rate. The Fed sets target interest rates at which banks lend to each other overnight, but it also sets the discount rate, the interest rate at which banks can borrow from the central bank. If the Fed raises interest rates, it increases the cost of borrowing to slow down the economy. On the contrary, in order to stimulate the economy, the Fed lowers rates, making borrowing cheaper and encouraging spending on credit and investment. Economic releases such as major economies, CPI data, non-farm payrolls, gross domestic product, retail sales, purchasing managers, index, and others can influence the value of a currency and create volatility. Politics, trade wars, elections, corruption scandals, and changes in policies can create political tensions which can influence the forex market. For example, Brexit and British or American elections have been major events in recent years which have affected both the political and financial spheres. Traders who are new to forex trading tend to choose liquid currency pairs like the euro against the USD or the USD against the JPY. They also spend a significant time on researching and learning the forex market and the currency pairs they are interested in by analyzing technical charts and monitoring economic data. Choosing the right forex trading strategy, cultivating discipline, and eliminating emotion are also important. Depending on your schedule and lifestyle, you can also choose the right time to trade, which will also determine your trading. You can choose from swing trading, day trading, or scalping. Whatever currency pair you choose, or what style you decide to follow, ensure you have a solid education and learn as much as you can about the market you want to trade. Thank you so much for watching us, guys. Bye-bye.
So yeah, let's begin. So yeah, the turtle trading strategy. Have you guys heard about it? Turtle trading strategy. So it was a pretty successful trading method. Well, it's usually used on the daily. So I'll show you guys. So yeah, welcome everyone for joining. My name is Chen Yongjing, and I'm the trade analyst for Everest Fortune Group. So our company, Everest Fortune Group, we are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So yeah, so we actually have a special collaboration with IronFX where we are bringing you guys the good stuff. Okay, the agenda, the topics for today. Who were the turtle traders? What was their trading strategy? Breaking down their strategy and improving on their strategy. We also will look how we can craft our strategy. Well, I'll be showing you guys how I implement it with my personal trading method. So yeah, who were the turtle traders? Let me get my device over. Okay, who were the turtle traders? Well, they were two people, two of them, Richard Dennis and Bill Eckhart. So they were part of an experiment in 1983. It was run by them, Richard Dennis and Bill Eckert. They wanted to test if successful trading could be taught to novices, people who did not know how to trade. So they taught the turtles who were their novices, a trading system that resulted in very positive results among the study participants. Also, some traders continue to use their trading system or their own version of it up to this day. So this method was from 1983. Just a very, very quick history lesson. Let me get the participants out. Okay. What was their trading strategy? So they enter a buy when price breaks above the 20/55 day high or low. I'll show you guys the indicator on TradingView in just a bit. So their stop loss is pretty subjective. A pretty subjective stop loss. Risk management as usual, only risk 1 to 2% of your account. For me, I personally risk 1% or less of my account. So it's the same for short trades. Price breaks below the 20/55 day high or low, and then you take a short. So yeah, they actually did the experiment. So Dennis, so this guy Dennis right here, Dennis actually believed anyone could be taught to trade the futures markets, while his friend right there, Bill Eckert, he countered that Dennis had a special gift that allowed him to profit from trading. So he felt that only certain people could trade, and most people are not meant for trading. So he used his own money and brought in some trading novices. Was a tremendous success. So the question right now is, the market conditions are always changing. We want to know whether this style of trading can survive in today's markets, whether does it still work. So turtle trading is also based on purchasing a stock or contract during a breakout, quickly selling on a retracement or price fall. So yeah, they usually do it on the daily. It was also one of the most famous trend following strategies. So they actually turned $5,000. How successful was it? Into more than 100 million just by using the turtle trading strategy. So yeah, it's extremely successful. It was a successful experiment, but now we want to know whether this style of trading can continue to survive in these volatile markets. So yeah, breaking down their strategy, they actually use the 22 and 55 days setting. Let me get it out in charts. Okay, so this is how it looks like. You can search on it. It's called the Donchian channel. So after I present this part, I'll get to TradingView. So the breakdown, the 55-day setting is normally used for the... Okay, I think I had this part wrong. Give me a moment. Not sure why this part. Okay, this is the 22-day. My bad, guys. So yeah, let's continue. So this is the 22-day setting. It's normally used for short-term trades and for scalps. For scalping, so this is the daily chart. Well, for the 55-day setting, you notice there's quite a big difference, 22-day and 55-day. So it's long-term, it's more for long-term trades, it's more refined, so there are lesser opportunities to enter a long or a short. And it's better to use the 55-day setting. So yeah, let's get right into TradingView first. Let's get right into that. So TradingView. So let me load out my layout. Why am I opening the file? So yeah, nice. Pretty good. Let me clear this out. Okay, let's take it on Euro. So you can actually search indicators. You guys can follow me, whip out your trading view. And take out your trading view and then you search Donchian channels. So this is what the turtles used when they were trading back then. So someone actually made an indicator out of it. Donchian channels. So you click on it. So you can take a look. So how do they trade? How do they trade? So example, let me set the thing to 55. 55 days, 55 settings. So for 55 is more accurate, but the chances of the probability or trade opportunities are lesser, but it's more accurate. So let's say you take a short here. So I just give a very, very quick explanation on how it works. So the moment price moves, and then it taps into the bottom this turtle area, and then you sell. So it's just a very simplified term. You sell, and then you take profit. You continue holding, but they only take profits when there is a price is pulling back or consolidating. So they only take profits when price pulls back or consolidates. So price can move, and then consolidating here, they can potentially start to take profits, close out their trade, or wait for price to tap into this orange color line. So I'm actually simplifying the terms, make it easier for you guys to understand. So yeah, they either through a consolidation, pull back a bit, some traders shut it down, or consolidate, shut down the trade, hit back onto this nice little orange moving line, they close out their trade. So yeah, how about taking a long? So let's say price taps into this area, they take a long position, but their risk to reward isn't that good. So let's say they take a long right here, but price below, stop loss, and trying to aim for one-to-one risk to reward, but it never happened. It didn't happen. So price nearly even hits the one-to-one risk to reward, but then it reversed back down. So yeah, that is why they manage their trade when price seems to be pulling back. So yeah, I honestly think it might be a pretty dangerous style of trading. You guys might have to back test it first. So yeah, this is only one indicator, and I always stress, please do not just trade using one indicator alone. Always use multiple indicators when you are trading. So yeah, let's take a look. Another example right here. Price tapped into that area. Okay, this area, it was a fail. Price went up, failed to break, stop loss. So this trade would be a wrong trade. So let's say here you take a long, price went up, long, stop loss at the bottom. You can be here, can be here. It's very subjective, as I mentioned in the PowerPoint earlier. It's a subjective stop loss. So let's say if you put your stop loss there, you don't even get one-to-one risk to reward. You get 0.9. But there are some ways you guys might you can refine it. Maybe you think that price might not hit back down to this area. So you might have a 1.26 risk to reward, but always do remember that is just the best possible scenario. So best possible scenario is at the top, but no way that we can trade and have a very, very perfect exit, right? So let's look to the left of the chart. So maybe there's some kind of potential area that we might want to take profits at. So let me clear this out. Actually, so far, where are you guys? Just interested, where are you guys tuning in from? See, you guys have nice names, Michael, Dale. So yeah, I'm from Singapore, by the way. I'm from Singapore. Let me send. So yeah, hi Josh, hi Antonio. Nice to have you guys on here. Is it the first time you guys heard about the turtle trading strategy? Let me continue. So yeah, with that said, with price heading up, best possible scenario, maybe we have a nice area right here. We might have an area. Some people might take profits over here, or they might take profit over here, or they want to take it when it clears the high, or even this high. There are many take profits area that you guys can choose. It's still very subjective, taking profits. Oh, nice, you are from the United Kingdom. Okay, I always wanted to go to the European side, UK. So I guess we are like across the entire world. We are far apart. So yeah, I'm in Asia. My country is very small, Singapore. So yeah, let's say you take profits here at the very top. Your risk to reward would be pretty bad, 0.67. But if you take profits at the high right here, I'm just showing possible scenarios. We might not always get this right. The risk to reward, just right, it hit 1. So yeah, the Donchian, this turtle trading style is actually taking quite long to take profit. So let's say I pull. It took a good, took quite a while. 2 days, 12 hours to take profits. But let us look at the daily where the original method was used. Okay, nice. You're from Portugal. Which part of the world is that, may I ask? What is the closest country? Let me check. Portugal, Spain. Nice. Okay, nice deal. South Africa. Wow, we have everyone from all around the world. Nice. All right. So we take a look. Let's say we go for shorts. Price moves. Wait, let me clear this out. Price moves, and then tap. We short. We take a short right here. Our risk to reward, we have it right up there for stop loss right there. But pulling it down, we want a minimum of 1-to-1 risk to reward. So let's say we are just talking about the best case scenario where price hits 1-to-1. It took very long, even on the daily. It took a very good 62 days for 1-to-1 risk to reward. That's not counting your commissions, the commissions you have to pay to the broker or the swap fees. 62 days for 1-to-1. So that is basically how the turtle traders traded. Okay, I see 2 Antonios. Are you guys the same person? Okay, yeah. So let's look at the long. I'm just looking for a possible long position. So spotted this area, price taps at the very top. Let's take a long. Okay, nice. You are the same person. Okay, nice. Okay, price went up, tapped, we pull, we have a stop loss right there. And we pull it up. We want a best possible scenario, 1-to-1 risk to reward. So pulling down, okay, this is actually not bad. It took a good about 7 days, 1 week for 1-to-1 risk to reward. So yeah, so you guys got the gist, a rough idea on how the turtle trading strategy is used. They are usually on the daily using the 55. For those who have just joined, it's called the Donchian. I saw quite a few people slipping in. It's called the Donchian channels. So yeah, I'm using the 55 rank. It's for longer term trades. So let's get back right into the charts, since you guys have already have a gist of what is going on. So yeah, you can improve on their strategy. So you are looking, their risk to reward isn't that great, but we want to involve other indicators, other type of concepts such as the MACD, stochastic, smart money concepts, and even ICT concepts. Any of you guys using the MACD, stochastic, or even smart money or ICT concepts? Do let me know in chats. Do you guys use that? Maybe you guys can, back test it out. See whether it's possible. Moving on to the next slide. So yeah, we can implement the moving average. So yeah, the moving average is actually already inbuilt in the Donchian channel, is the orange line. So I'll just move on from there. Moving average, when you just adding confluence, price steps into that area and price is underneath the orange moving average line, guys can sell. But then maybe I'll show you guys better methods to increase your risk to reward ratio and have a better entry. So maybe you guys can implement this stochastic indicator. Price goes up at this area, it's coming down. So we are looking at maybe possibly this area. Price is coming downwards. You can sell it, sell until price hits the oversold area. So at the oversold area right there, you guys can probably exit your trade. Let me clear out this chart. It might be a little bit messy. So yeah, in another scenario, okay, let me move up. In another scenario, using this stochastic indicator, price, let's say it's here. You're looking for sell. Price went in, continue sell. But where can you potentially take profits? So around here, maybe when price starts to reverse back up, this area I see a reversal. So moving upwards, it's around here. Potentially, you might have actually closed your trade already just by implementing stochastic to the turtle trading strategy. So yeah, my very, very favorite method is using smart money concepts. So just by using smart money concepts, I can potentially know where to take profits or start to look for a sell. So maybe at this area, price went up and I can start to buy. But, sometimes your risk to reward might be negative. A negative risk to reward, but you don't know where to take profits at. So take profits, you can use smart money concept. So this is called the supply zone. So at this supply zone is an area where you can potentially take profits, stop loss, not sure how, it's on the daily, it might be possibly at the bottom here. Take profits right there. Risk to reward is negative, but profit is profit, right? I actually do know some people who are profiting using a negative risk to reward. And yet they are full-time traders, negative risk to reward, scalping. They are just scalping, everything adds up, they make money. So yeah, this is another way that we might potentially enter. Let's say this area right here. Let me clear out the charts. This area right here that we are looking at. So price goes down, breaks. But you want to have a better entry. So we wait for a pullback, a retracement pullback for price to tap into the supply zone. And then we short. We take a sell with our stop loss at the top there. And then the risk to reward might potentially increase to maybe 1 to 3, 1 to 2. It's even better. Let me go to the live charts to show you guys. So yeah, so maybe on the daily right here, let me clear this out. So let's say price coming down, coming down. Then you want to sell. Coming down right here, you want to sell. But wait, hold up. Let's price. So in another scenario, you wait, and price already went quite low. It's not wise, like, to have a sell right here if you missed out on the entire trade. Stop loss at the top. But by then, how long do you want to wait for 1-to-1? It's going to take weeks, months to have a 1-to-1. So how are you going to improve on that? So using smart money concepts, you can potentially use and possible what they call it a breaker block. Why is it called breaker block? Because using smart money concepts, this is the last area. Let me draw it out. Where's the brush? Where's the brush? Okay, this is the last candle that caused the rise up and break in market structure. So this candle caused both of that. So looking at that, we can potentially have a short. You guys can actually look up on smart money concepts on YouTube. It's very informative. You guys can actually have some kind of. So actually, sometimes when I use smart money concepts, I managed to get some pretty nice sniper entry type of trades, looking nice. So you look at your meta trader, you shot from the top. It looks pretty nice. So yeah, it looks like it's an Instagram style trade. So yeah, it's pretty nice. You guys can look up on smart money concepts. So with our stop loss at the top here, at the last area that caused the break in market structure, our risk to reward has significantly improved. So let's say we want a one-to-one risk to reward. We only got to wait instead of 7 days. Just now the best one was 7 days. We waited in total of only 8 days. Okay, still 1 week, but it's much better. So normally where you want to aim is for price to continue going down. As I mentioned, the turtle traders wait for price to consolidate, or tap back into this line for them to close out their trade. So potentially once this area starts to consolidate, they might have already closed. So to give a benefit of a doubt, maybe they close it right here. It can be anywhere, but then the risk to reward is more than 1-to-1. For this scenario right here, you can see it's 1 to 1.43 risk to reward. So yeah, any questions so far? If you are confused, do let me know. I can slow down. I can re-explain what I was explaining. Any questions? Or what kind of trading methods do you guys use? Maybe I can try to help implement it into the turtle trading strategy. Do let me know. I'll try my best to help you. Wait, so let me adjust this mic. Okay, all is well. Let's move on. So yeah, maybe I'll just show more examples. Closing this out, I just clear the chart. Oh, you said you are new in this, so you are just adapting to this area. Oh yeah, what do you mean by you are new in this? Are you new to trading? Are you new to trading, or is this a new trading style that you are probably looking at, the turtle trading strategy? Adapting to this new area. Do let me know if you are a beginner, so I can maybe slow down, try to explain more of those slightly confusing stuff. Let me move this, move that. Okay, so for maybe you are typing, I'll just continue for a while. So yeah, looking at this area, maybe looking at this area, price tapped, looking for shorts. So you actually saw price, let me get the brush out. Brush tapped into the bottom area, but if you look for short immediately, it would have been a stop loss at the very top, stop loss there, and you got a best case scenario, not even a 1-to-1 risk to reward. So let's implement smart money concepts here. Let's implement it here to have a better entry. So what you want to do is wait for price to retrace. So price retracement, meaning you are waiting for price to head back up for a better solid entry. So this is where you can actually implement the, let me get this out, the supply zone right here. So with that supply zone, I'll just put it in red. supply zone there, you can take a shot, and your stop loss at the very top at the previous high. Let me get the, where's the call out? This is known as the previous high. So yeah, your stop loss can be at the previous high, and then 1-to-1 risk to reward. It took around 7 days. It's still 6 days. Pretty much nice, but as usual, for turtle trading strategy, you continue holding your trade. Just remember, this strategy is for people who do not know how to trade. They are novice traders, so they would not know that if price has broken some kind of random area like here, so they would probably control their trade. No, for total trading, you are just new to trading. You hold, the trade went down, but then price reversed. So price reversed. Wait, let me get the brush. So price reversed up here. You might probably close your trade back up there with a 1 to 1.45 risk to reward. So yeah, turtle trading is just holding. They enter already. They just hold until either price reverse or consolidates. Hey, yeah, you are new. You are in Iron just with a friend that's trading for me. Oh, so you actually do you put money with your friend and he trades for you? Trades for you, but I would suggest you learn trading so you can actually enter your own trades. It's better to learn trading, instead of asking. I know it's fine to ask someone to manage your money, but it's also good on the side, especially now you are joining this webinar, you are learning, understanding how trades are executed. It's very, very good knowledge. So when I first started trading, my friend put me in, same thing. I actually gave some money to him to ask him to manage, but he actually blew the small accounts. I gave him a relatively small account, $100 only, since he said he knew how to trade. So I gave him $100, let him manage it, but the risk management was pretty bad. So yeah, he actually blew my $100. Oh yeah, you said your friend is trading daily, buy and sell in the same day. Oh, how's his performance? Is he making a sizable return? How much percentage is he making back on the accounts? So yeah, so I was saying back then, my friend actually blew my $100 that I gave him. Back then, I didn't want to learn how to do trading. I just wanted the money to work for me, getting back a huge sizable sum. Oh, nice. 1% a day. That's a lot, man. 1% a day, that means, okay, plus minus 1%. That's a lot. So to take that, so for those who are listening, 1%. So his friend is actually helping him make 1% per day. So let's take it as a week. So it's 5% a week and 20% a month. Take that into consideration. The account is $1,000. He's getting back $200 in profits in a month, which is very, very good. What method does your friend use? What does he use? What does he use to trade? That's actually a lot, man. 1%. So yeah, just to maybe put into perspective, for small account holders, many of us, we don't know. Do ask him. It's actually interesting. You can find out what method he's using. And you can actually learn, you can start to research and try to trade on your own. Maybe you can start with a demo account. Why not start demo accounts, start to learn? So yeah, maybe put into perspective. So usually on small accounts like this, $1,000, many people are using $1,000 account, $100 account, $500 account, and even $10,000 account, 10K. So what they like to do is they like to aim for those very, very huge profit return. 10K account, they try to aim 10% per week. So 1 month, 40%, they aim to make $4,000 on their $10,000 accounts. But I know someone in real life, he actually handled, let's put into perspective. This is real life, someone that I know. He was handling $20 million in Forex account. So he was managing people's money, $20 million in cash. And then what was his risk? He only risked around 1% or 0.5% of his accounts. So per month, he only needs 3%. So he was only up 3% per month. This is per month. I'm just sharing my life with you guys, 3% per month. So he's making around 600,000. Let me get the calculator just to confirm the calculation is right. 20 million times 3%. So yeah, it's 600,000. 600K profit. So yeah, if you are looking at a huge amount of money, so 500,000, $1 million account, you guys might probably want to look at the smaller percentage. Just small little 3%, you can make a lot. But unfortunately, not everyone has that privilege. I'll just delete this out. Not everyone has that privilege to, have a very, very huge account, $100,000 account even. So many traders aim for huge percentage gains just to make that nice $4,000, $2,000, $3,000. But when you are chasing the money, just remember your psychology might be hit pretty hard when you lose a trade, because you are just chasing the money. You need to make that certain amount per month. Hey, nice, you are with him for 2 months. So how's your gains with him for the past 2 months? May I ask? If that's a sensitive question, you don't have to answer. It's okay. It's fine if you don't want to answer that. What was the gains that you had? So yeah. So with that, let me continue for a while. Let me continue this area. I'll try to find maybe a long retracement. Let me find a good trade setup. So total trading is not for everyone, because you have to wait. There's a very, very long waiting time for trades to happen and for trades to move to a direction you want, and you have to monitor it. So in such a situation like this, let's show a failed trade. So let's show a failed trade first. So let's say price tapped in, you're looking to sell, but you remember, Yongjing told you to wait for retracement. Wait for retracement, and then price went up, went back up, and then you try to short it at this little area, but price continue moving upwards, hitting your stop loss. So yeah, you should have some kind of nice stop loss, tight stops, where you must set a stop loss. Just remember to set a stop loss. You do not set a stop loss, you can potentially blow your account. Well, you invested 5K initially. In the last month, you put more than 10K. Hey, that's nice. You're with him more 3K plus. Okay. So you actually threw in more money. You made 3,000 over with him. But the very, very big question, okay, just for your safety, just in case you get scammed or something. I'm not saying that your friend is scamming you, but do you have access to the money? Is the money in your own broker account? Or did you pass him the cash entirely? There's a very, very big difference whether you have control over when you can withdraw the money. Better do check that out, just in case, I'm just worried about the safety of you guys, man. So yeah, maybe in this situation, okay, we can continue first using the ICT concepts. So who has heard about ICT? Say in chat, what is ICT? ICT is inner circle trader. So that's the ICT concept. You guys can actually learn from him on YouTube. That is his logo right there. He actually teaches things for free on YouTube. You guys can check it out. I think it's very, very informative. I've been using some of his concepts with my trades and it's working pretty well. So yeah, ICT concepts, mainly he has the use of market imbalance. So this is something, market imbalance. This is something that maybe you guys first time hearing it. It's very, very important when you're trading. So I actually back tested the market imbalance concepts that he was talking about. And yeah, it ripped some, it was very good, very good. Let me show you guys on the charts. Let me show you guys, wait, give me a moment, pull things up. Okay. Wait, get me a moment. ICT concepts. So he focuses a lot, from ICT concepts, he focuses a lot on market imbalance. So what do I mean by market imbalance? If you can see right here, do you like it when price does this entire area? Or do you like it when price moves very nicely in a nice order flow fashion? But if price measures down like that, like this area right here, I don't like it. Why don't I like it? Is causes a lot of imbalance, like Marvel MCU, causes a lot of imbalance on the charts. So what do we have here? If you draw from the top of this area, this candle right here, to, okay, let me get it. Okay, maybe I use a different color. Draw from here to here, you can actually notice that price tapped into the market's imbalance area. So this area is an imbalance. Price previously did not come into this area, but it came back up to tap before it continue going downwards in this bearish market. So yeah, you continue looking. Let me show some more examples. Price tapped into the market imbalance area before it continue moving down. Here too, price tapped into this market imbalance right here before it continue heading down. So yeah, just do back test. I'm just showing you guys some kind of back test where you guys can fall on data to back up this market's imbalance theory. So you can draw a rectangle right here, same thing. Price tapped into the market imbalance before it continued going down. This area right too, price initially tapped into it, but went down before there was a shift in market structure. This is a higher high was formed. This was a previous high, but a higher high broke the structure. Okay, yo, Antonio, is that you, Antonio? Okay, you said thanks. You have two accounts, the original and a secondary. That's the one he's managing. Initially, he was trading with IG. Well, the question is maybe what I was trying to ask was, do you have control over the accounts? Like you can log in, you can withdraw your funds. You have control over the accounts that he's helping you to manage. So yeah, this is the market's imbalance. Very, very nice order flow that I'm talking about. Okay, nice. Okay, that's good. Okay, I'll just worry about your safety, bro. No, there are quite a few. My friends actually got scammed on Telegram a few years ago during the COVID pandemic. 2020, they had the Forex, there were a lot of Forex scams on Instagram, on Telegram. So people told him to deposit like $500 US, $1,000 US, transfer the money, they will manage it for him. So he actually transferred $500 US to someone over Telegram. And he never got the money back because the person promised huge returns. So yeah, I'm just being wary, just asking you guys. And that same guy who was he did not want to learn trading also. Back then, he asking people to manage money. That's the reason why I'm just sharing. Hopefully that you will learn trading. Hopefully you can manage your own money. You can do well for yourself. So yeah. So my friend, lost a lot of money due to all these scams, and he actually took time to learn trading. He sat down, learn, and then 3 years later, since early 2019 until now, 3 years later, he's actually trading pretty profitably on his own. So yeah, it takes quite a lot of time to learn trading, but once you get the gist of it, I told him, well done, man. He actually took the time to learn. So bro, Antonio, so maybe I can get you started on trading by yourself. So maybe no, I wouldn't stop you on what you are doing, but maybe you can start to learn on Inner Circle Trader. You can search it on YouTube, bro. Inner Circle Trader or Smart Money Concepts. You can read these two up. I really recommend it. I really recommend it. I have a friend right now who currently do not know how to trade. I recommend him Inner Circle Trader or even Smart Money Concepts. They actually start to understand, start to see, oh, where did I enter the buy? Where did I enter the sell? So maybe you guys want to see how I trade. So the turtle trading strategy is just like that. So if I were to give my personal opinion whether the turtle trading strategy still works in the current market, I would say the rewards reaped from this method is not that great. The risk to reward isn't good. It's not that good anymore. Because last time, people always believed that stocks would continue rising. They always believed that stocks would continue rising. So back then, if the turtles were trading in a long, they were buying, heading upwards, they could have reaped that profit. So I would believe they turned 5,000 to 100 million. So I would believe that back then there was like only one trend was forever going up. So yeah, right now it's volatile, price moving different ways. There's many events going on in the world, the Russian-Ukraine war, and especially those who are trading right now, do be careful of the US midterm elections. It might cause more volatility in the markets. So maybe just to show you guys how I trade, I'll clear out the charts, I'll close out this indicator. I'll just present to you how I trade. So I normally like to craft. So I'm using Smart Money Concepts and some ICT style concepts. So how I trade is, I always like to look at the daily first, top-down analysis. You can see I don't use any indicators. I close out all my indicators, everything is crossed out. So let me exit out. So I don't use any indicators when I'm trading. I don't use RSI. I do not use a MACD. So how do I do it? I like to craft a story on the charts. So it's like I'm looking at a picture and I'm explaining to people what is going on. So looking at this area, I want to know, why did price cause this bounce? I want to know every single part of the chart. Why did price cause this? Why did price cause this? I want to know, why did price reject down to? Before I start trading any currency, I want to know the story. So there's a storyline behind it. So if I draw a line right here, using Smart Money Concepts, draw with a magnet tool, you can press this magnet tool, it sticks, you can see, it sticks very nicely. Stick it, you draw one line. So what did you notice? What do you notice? Let me zoom in. Price went down to clear all these wicks, clear all this liquidity. Just take it as, just imagine the market maker went down to cut out your stop losses, gather enough money and continue heading upwards. Just imagine it as that. So I'm using an imagination. That's not what is actually happening in the market. So I'm just saying that price came down to grab liquidity from all these areas and then continue heading upwards. So what do you call this area? I call this the sell side liquidity. Let me change the size to 16. So sell side liquidity, price came down, grab liquidity and continue heading upwards. And we have a minor liquidity grab right here, but I will not write it out. And price went up. Why did price reverse from this area? So I'm looking, liquidity was built up here and here. So I'll draw out. Price went up to this area and cleared the buy side liquidity. So let me change the text size to 16. So buy side liquidity was cleared right here. That's the reason why price reversed back down. But looking at this area, I'm trying to craft out a reason. I can't see anything on the daily. What happened? What's going on at this area? Why did price, what was this area that caused price to bounce? And if you look at the dates, this was on Friday, 4th November. It was the release of the US, the NFP data. So NFP data release, it's a very, very important event. So Antonio, do take notes, the first Friday of every month, they release the NFP data, but the unemployment rates worsened for the US dollar. That's the reason why Euro USD continue going up. So I cannot see anything on the daily. I move on to the 4 hours to get a better picture, craft the story on what is going on. So what do I see? What do I see? I see that price came down to the demand zone. Demand zone. So I'll just turn it green. I'll name it the demand zone. Inside center. So price tapped into the demand zone before it bounced and continued bullish. Well, and then looking back at this area, I want to know what is currently going on at this current area. Price recently cleared also the buy side liquidity. Buy side liquidity was cleared. So yeah, that's why it reversed down. It cleared the previous high, causing price to reject. So where are we located right now? Looking at the 4 hours, where are we located right now? We are currently within the 4 hours market imbalance area. So I draw a line out. You can take a look. We are currently resting in this imbalanced area right here. We are currently inside. So with all this liquidity building up, I might potentially say price might reverse, might potentially go up, clear this area, close. So I'm actually looking for scalps. I do not do swing trading. I do not try to swing a very huge part of the markets. I take shots or longs on the 15 minutes, 5 minutes, or even the 1 minute chart. So with that being said, I'm on the 4 hours. Let me type it out. 4 hours market imbalance area. 4 hours market imbalance. I'll move on to the 1 hour. So moving on to the 1 hour, I noted that price is still in that area. So what I want to do is, there's no picture for me to pin right here. There's 1 hour, there's nothing. We are in the 4 hour market imbalance. Moving on to 30 minutes. Is there anything on the 30 minutes? Yes. Price tapped into the 30 minutes imbalance area. So maybe I can mark it out, but let me check 15 minutes first. Nice. 15 minute tapped in. So I can clear out the 4 hours one already. I'll rename it to. This is how I do my top-down analysis. 15 minutes market imbalance. So price is currently there. So if I were to look for a long, how does a breakout structure look? It looks like this. Price goes down, up. Then what does it do? How does a breakout structure happen? Price goes up. It breaks this area. Comes back down, heads up. This is where you start to take your long. Same thing. What I'm looking for is, look at this. I'm looking for price to potentially break this area before I wait for price to retrace, and then I buy to the upside. So just marking it out quick on the charts. So for tonight, I'll probably be pretty chill. There's nothing for me to take at the moment. So I'll just hold for price to break our market structure top. I'll just wait for price to break that area before I look for any potential longs to the upside. Maybe clearing this high right here. So yeah, this is how I trade generally. I'm actually looking for longs right now. I'm not looking for shorts. So if there's no longs, there's no nice things for me to take, I wouldn't take anything. So yeah, any questions so far for you guys? Any questions? So I'm just showing a very, very quick overview on my personal trading method. Okay, so yeah, that's about it for today, guys. Any more questions? Feel free to let me know. I give you guys another, maybe 30 seconds to ask me any last questions before we end this webinar. Okay, my throat is pretty dry, a bit tired. Drinking is just talking, then my throat got dry. So yeah, guys, if there are no further questions, I'd like to thank you guys for joining me today on this webinar. Let me scroll up. Thank you very much for joining. Hope you guys stay safe trading. There's the US midterm elections coming up. Stay safe trading. Take care. Your risk, just manage your risk. And Antonio, remember, just take your time to learn how to trade. It's fine. And yeah, you guys have a nice day, man. Hey, thanks. Thank you. Hey, bye, man. You guys are the best. Thank you for supporting me. Goodbye. I shall leave now. I take my leave. Bye, guys. Stay safe.
Hello and welcome to another educational video. As part of our technical analysis series, we would like to look at trend lines. A trend line helps technical analysts determine where market prices are heading. A trader using technical analysis will utilize trend lines to identify and confirm market price trends. This is based on the idea that price trends. The trend line is nothing more than a straight line drawn between at least 2 or more points. An uptrend line has a positive slope and it's formed by connected 2 or more low points. In order to have a positive slope, the second low must be higher than the first. Uptrend lines act as support and point out the net demand it's increasing as the price rises. An increasing price combined with increasing demand is very bullish and shows that buyers are determined to buy. If prices remain above the trend line, the uptrend is considered solid. A break below the uptrend line suggests that net demand has diminished and a change in trend could be looming. A downtrend line has a negative slope and is created by connecting 2 or more high points. The second high must be lower than the first for the line to have negative slope. To confirm that the trend line is valid, at least 3 points must be connected. Downtrend lines act as resistance and demonstrate the net supply is increasing as the price drops. A falling price combined with increasing supply is very bearish and shows that sellers are determined to sell. If prices remain below the downtrend line, the downtrend is considered solid. A break above the downtrend line indicates that net supply is falling and that a change of trend could be looming. The trend line becomes more important and more credible as the number of price extremes that can be connected by a single line increases. The validity of a line that connects only to price extreme is questionable. Most often traders can take profits too early. It is best to stay with the trend until it breaks, avoiding the desire to sell too soon because the profit could be higher than originally anticipated. Thank you for watching.